Hey everyone, welcome in to another daily editorial here on the KE Report. In this daily editorial, we're going to be doing a little more looking ahead in terms of central bank meetings, elections, and economic data coming out in the next couple weeks. We are chatting with Marc Chandler, managing partner at Bannockburn, Global ForEx, also editor of the Mark II Market website. Now, Mark, look, this week was a little slow, and in all fairness, a lot of markets that were doing very well, they've lost a little bit of momentum. Nothing is really crashing on itself, but it seems like the markets, at least this week, slowed down. That could have been because of the lack of economic data, earnings, central bank comments. But you know what? The next couple of weeks pick up a fair bit. You were telling us off mic that you think the next 2 weeks could be the most important leading up to September, kind of throughout summer here. Mark, just a quick overview. What are you watching in the next couple weeks that all come together that, who knows, maybe could give us some more clarity on the next move in markets?
Thanks, Corey. I'm kind of thinking that there's only two things that really move the markets, that really excite us, huh? Politics and economics. And those forces come to play in a big way in the next 2 weeks. Here's what I'm seeing happening. Starting, thinking about next week, we've got two central banks, G10 central banks that meet, both the European Central Bank and the Bank of Canada. The market says that the ECB rate cut is a done deal. And it's got about an 80% chance that the Bank of Canada cuts as well. And that follows the slightly softer than expected P figures earlier today on the last day of May. So we could have two more of the G10 central banks cut. They'll be joining Switzerland and Sweden, who have already delivered rate cuts. And this also gets the idea of two things. One is a monetary cycle, so it solidifies that among the industrialized countries, the monetary easing cycle is solidifying. That is, it's turning and it's broadening out, more countries participating. Secondly, it underscores the idea that these other central banks are cutting before the Federal Reserve. And still ahead of them probably will be the Bank of England, maybe not until late summer or something like that. But in any event, we got these two G10 central banks that are likely to cut rates next week. And then I want to say we can't forget about politics. It gets kind of messy, a lot of things happening. One, South Africa had an election earlier this week. The election results don't look good for the ANC, the dominant party for the last generation, basically. And the South African rand and the stock market and the bond market have really been punished by the uncertainty of what a coalition government is going to look like in South Africa. India, the largest democracy of the world, is having their own election. We'll get the results probably also in the next 2 weeks. But next week, we get the European parliamentary election. And this is going to be important. Partly, you already see how Europe has delayed making a decision about the Chinese imports of the Chinese, autos coming into Europe from China. People had expected some tariffs to be announced next week. Those look like they're going to be postponed until after the European parliamentary election, which in that process, as that process unfolds, it will include a new European Commission. So we've got so basically we're looking at a European parliamentary election beginning the same day that the ECB meets. And at the end of the week, we get the US and Canada's jobs data. It seems to me that there's two important economic releases in the current mode of the market's been in now, say post-COVID: employment and the CPI in the US. So we get the jobs data next Friday, and the market right now is looking for something a little bit stronger than we saw in April, which was 175,000 rise in non-farm payrolls. Big picture sense is that the labor market is slowing, but very gradually. The following week, still trying to stay in that important week because the CPI is coming out, the other important U.S. economic data, a high-frequency data point, and the Federal Reserve meets. Now, the market has long given up the idea that the Fed could hike rates in June, but what's going to be important from the meeting is going to be the dot plot. That's that summary of economic projections in which the Federal Reserve tells us where they're currently thinking things look like. So it's just a snapshot, if you will. And remember in March, the median dot was for 3 rate cuts. And so it seems to me that everything's pointing, that is the rhetoric, the data, all point to something less than 3 cuts this year. And so I would imagine the median dot goes, I'm kind of suspecting it's going to go below 2, which is really where the market's at right now. Looking at the Fed funds futures, market's pricing in 1 cut fully and maybe a 50% chance of a second cut. And remember, back in middle of January, as recently as middle of January, the market was pricing in 6 cuts this year.
Well, Mark, when you consider those jam-packed 2 weeks we have in front of us, all of the central bank meetings where we could see more rate cuts, the elections that could particularly bring in new regimes or new ways of thinking about the economy, and then the U.S. jobs data, all of that together, we were joking off mic that it's like lions and tigers and bears, oh my. What does that mean for the potential effect on the currency markets? How could that affect the European currency, the Canadian currency, what's going on with the Mexican peso and the US dollar? How does that all figure into the equation?
Yeah, thanks, Chad. You're right. One of the elections I inadvertently skipped was the Mexican election this Sunday, June 2nd. And there, of course, speaking to your point, maybe some sense of continuity as it looks like AMLO's handpicked successor is going to become the next president. We're going to be watching those legislative elections closely. And in a big picture sense, I think the only thing that really matters, leaving aside these data points, is really whether it's a surprise or not. And so when you have all these events in data, and some of this data, like the jobs data, very difficult for economists to forecast. And so I think that the risk is then some volatility. But in my mind, we're still stuck in ranges, and the recent price action really highlights the importance still of those ranges. For example, in the euro, it's roughly 107.85 to 109. In the Canadian dollar, even though we flirted with the 136 level on an intraday basis in the past couple of weeks, we haven't been able to close below it. And so if 136 is the support, 137.50 probably the upper end of the range. And for sterling, I was thinking that range is also fairly identifiable. We tested 128 earlier this week. And I think that's the upper end of the range, and the lower end of the range probably 126 and 3/4, 126.75. And so I think that for short-term momentum traders, trend followers, I think that we really have to break those ranges to be anything significant. And I think that the bias is, in the big picture, I think the bias is going to be towards a weaker dollar. Already the speculative positioning in the futures market, the IMM, have the market now net long sterling and the euro for the first time. It's happened earlier in May, but it's for the first time in several weeks that the speculators are net long. But so in the big picture, I think that the dollar weakens as the Federal Reserve cuts rates, the U.S. economy slows. But we're not there yet. And we've had this I should say, a relatively big rally in the euro and sterling and the Aussie really since the middle of April. And the issue to me is whether that move up in those foreign currencies, down in the dollar, where are we on that? Is that range? I had previously thought, I think last week when we were talking, 2 weeks ago when we were talking, I was very confident that the dollar was going to recover. We had a recovery that first week. At the end of last week, I became a little bit more unsure. The price action ahead of the long holiday weekend in the U.S., the U.K. was a bit negative for the dollar. We chopped around this week, and I think that's really the key issue is whether we really get the dollar recovery or whether we go sideways here as the currencies, as the overstretched momentum indicators in the foreign currencies become alleviated.
Mark, the dollar's been moving sideways here for a couple months. So, yeah, maybe some more direction, either up or down on the back of this. But as much as there are elections coming, you mentioned the central bank meetings, and everyone focuses on the Fed. But how big of an impact can these other central banks in, albeit fairly large economies, how can they impact markets given that they're not as big as the Fed? Everyone pays more attention to the Fed. Does it matter for the markets that these other central banks are going to be cutting?
Well, I think in some ways it does. I mean, but I think partly, Corey, it depends on the time frame and the broader context. For example, as we are winding things down here in May, the U.S. premium over Eurozone on 2-year money has fallen to below 180 basis points, which is like almost a 2-month low. And so this is despite the fact that they're going to cut. People feel pretty confident they're going to cut. I think it's not just, I think it's funny, I've been thinking about this, explaining this to someone else, that it's clear we don't live in the analog world anymore. We live in more of a digital world. And here I'd say that central bank meetings have two digits. One is for the policy move. So the ECB is going to cut, so that would be a dovish. But they're going to try to ward off speculation that they're going to cut rates again in July. They're going to possibly revise up their growth forecast, and so the signal will be then we'd say is the second digit would be more hawkish. So it could be the ECB delivers a hawkish cut. Now, if instead they say our economy is weakening fast, despite having that recovery after contracting in second half of last year, the economy really doesn't have much momentum. It's inventories, it's government spending. We're going to have to get more aggressive on cutting interest rates. And sorry if we have to do this ahead of the Federal Reserve. If they were to say something like that, which is unlikely, I think the euro would get punished. We'd probably drop towards 106. So I think what these other central banks do and say matters. What ultimately matters is it a surprise. And I think a hawkish cut by the ECB would not be much of a surprise. On the other hand, thinking about Bank of Canada, the market, as I said, is only about 80% there. And if something happens and the Bank of Canada doesn't cut, that could also spur a reaction in both the interest rate and currency markets. So I think they're important. Of course, G10 central banks are important where we are in the cycle. It's not just for currency traders, but the whole range for businesses, for asset managers. I think of it like a big S curve and be locating countries where they are on that curve.
Well, Mark, we'll be looking for any surprises either way, things that are maybe more hawkish or more dovish from any of these banks, and obviously any potential surprises in the elections to come. But I think most people have forecast the way those elections are going to go. We'll look for any surprises in the job data. You mentioned in passing there, though, that we're kind of in this digital, more ethereal age. But let's talk about raw commodities, which are hard assets. They all rolled over this week. Do you think that ties in with some of the action we're seeing in China? Do you think that ties in with some of this financial expectations on the currencies? What do you think caused commodities as a whole to roll over this last week?
Yeah, I don't know. I mean, I kind of think oftentimes what I like about currencies is what I was saying about just the central role of the dollar still. In commodities, I find that like perhaps it's just the idea that they're all like idiosyncratic. So I'm looking at for a lot of our clients, copper is an important metal for various machinery, electric, all that whole meme, as well as for current industry. And their copper prices peaked May 20th. And I have the July copper going from 520 down to 460 this week. And so I think that part of this is people who are bullish commodities rode them up and now are having to unwind them. Why are they unwinding? Partly, I think that some growth concerns, what happened in China, figuring out rationalizing the production. I think so. So I'm not sure, but what strikes me the most about the decline in the metals is really that it happened alongside a softening of the U.S. dollar. And typically people think that they move in opposite directions. But here's a period of time in which we've got a softer U.S. dollar generally, and we've got as you mentioned, many of the metals rolling over. To me, it's typically idiosyncratic stories, but the broader picture is one maybe of a disappointing Chinese growth and maybe a slowing down in the U.S.
Yeah, it also matched with the rollover in the U.S. equity markets too. So it brings up the question of this rotation trade. It's something we've talked about for the last 2 years now. What's your assessment of the rotation trade? Is it still here? Where could money be rotating to next?
Yeah, I don't know. I'm really lost right now. I mean, I think that asset values, it seems to me, in the U.S. are stretched. The economy going to slow. Europe might not be slowing, but it seems to me that their equity market also stretched, not necessarily compared to the U.S., but in their own terms. I kind of think that I'm trying to think to myself, what companies, what sectors benefit from. So thinking more downstream. If the semiconductor chips are overvalued, then maybe looking at something downstream who services them. And at the same time, country-wise, and that's what I try to focus on really on a country level, I still think that East Asia might be the biggest beneficiary of the de-risking towards China. At first, many people thought the near-shoring, friend-shoring helped Mexico, and maybe there's something like that going on. But I think that more broadly speaking, that might be used to service the U.S. market, but maybe a lot of the supply chains move to Vietnam, Thailand, Indonesia, stay for the most part in the Asia region. because that's really, when you think about it, just the big picture, demographics. And the big talk, of course, is the dearth of births in the high income countries and in medium income countries. But when you look at a map and think about the demographics, even though Taiwan and China shrink and Japan shrinking population, you're still looking at half the world's population in the Asia Pacific. Give me India, China, Indonesia, Japan, and you've got a lot of things happening there population wise. So I kind of suspect that's where I'll be looking for value opportunities.
Interesting, Mark. So maybe a switch from domestic to looking at the Asian markets as an opportunity. One other area of the markets in the U.S. that I think we should circle back to, and we were talking a little bit about this before we started recording today, and that's the bond market. You'd mentioned that despite having some weak bond auctions earlier in the week and even last week, that there was going to be some, I guess, additional buying from the Federal Reserve and in the bond market. And there's been some interesting reactions in the rates when you think about a bond market that hasn't been well supported. You would have expected rates to go higher, but rates actually came down. So make sense of the bond market to us.
Yes, you had the two big developments people should be aware of happening in the U.S. Treasury market. The first is that starting this past week, the U.S. Treasury began a buyback program. And what that means is that they will be buying back what we call off-the-run issues. Off-the-run issues are previously sold bonds. They're not, and especially when you think about a 30-year bond sold 5 years ago. A bond like that might not be actively traded. And that might, Treasury thinks, impact trading and liquidity. So what they want to do is buy back some of those illiquid bonds, and then just add that to replace them with more liquid bonds, like at the next auction, or stretching them out, of course, over a period of time. So the Treasury then is going to be buying back some off the run, some older Treasury issues, and increasing the size of some of their future auctions. And the second development, that starting in June, the Federal Reserve had already announced this. Starting in June, the Federal Reserve is going to taper its QT. Remember, QT is the unwinding of its balance sheet. It bought a lot of treasury bonds and agency bonds during COVID, and now it has been shrinking its balance sheet, letting these issues that mature, just not replacing them with new issues. And they've been doing that to the tune of about a cap of about $95 billion a month. Starting next month, they're going to slow down the unwinding of the treasuries. Right now, or I should say in May, they allowed about $60 billion worth of treasuries roll off their balance sheet. Going forward, they're only going to allow $25 billion, which, to your point, Shad, it means that they're going to be buying more treasuries. And so between the Treasury Department itself with its buyback and the Federal Reserve replacing more of the maturing issues, that some people thought there'd be a better bid to the Treasury market. And sure enough, to your point, the Treasury market the yields did rise initially this past week. We got a little bit past 460 on the 10-year, on the U.S. 10-year. And that's sort of put that in perspective for you at 460. We had gotten down around the middle of the month to about 430, and we had hit a high for the year in late April. And that high was near 473. So that's sort of the range, 430, call it 475. And from that 475, we fell back to the low end of that range. And we did rally last week, but we're pulling back these last couple of days. We're finishing the week near 450. And remember, like I said, we peaked almost at 465. So we've had a nice pullback here. We've had some softer than expected data. We've had a drop in oil prices. So a lot of different factors, end of the month, a lot of different factors could play a role, but some people will likely attribute it to the buybacks and anticipation of the Federal Reserve tapering its QT.
Isn't that a huge story, though, Mark? Couldn't that very well put in some sort of a top for bonds simply because we are losing, or at least one of the major sellers is slowing down?
There's a narrative that you can build around that. I kind of suspect at the end of the day, what's going to really matter is the economic data more than the sort of micro market story. And I think that part of the reason, to Shad's point about what happened earlier, was the poor auctions. So we had 3 auctions and they all tailed. That is to say, they all ended up requiring a higher yield than were prevailing before the auction. And so why do we get the tail effect in the U.S.? Partly because I think that the supply, each issue has basically increased. And so this is just a minor indigestion problem, I'd say. What's going to happen then, the Federal Reserve's buyback, you think, okay, well, that'll support this off-the-run issues. That's fine and good. But now they're going to have to increase the supply of the next issue or of the issue down the road. And won't that offset it? And so I think that the way the Treasury thinks about it, that's going to be really yield neutral. But market psychology is a different thing. And the same thing is true, I think, about the Federal Reserve's QT, the unwinding of its balance sheet. Yields did rise, say the first 4 months of the year. We were at that 10-year yield was at 380 at the end of last year. Like I said, by late April, it was already at 470, almost 475. So you can say, well, is that because of the Fed QT? Well, I don't know. But one possible explanation to me, what really was happening was the market got way carried away. Last December, when the Fed said they'd cut rates 3 times, the market began pricing in almost 7 cuts. And so they had to correct that. And as they corrected that this year, that pendulum of market sentiment swung back and yields rose as a result of the market's own doing, position adjusting rather than the pace of QT.
All right. Well, Mark, thanks for sharing your insights here. A lot for us to watch out to in the next couple weeks. But hey, some of these elections, central bank meetings, even what the Fed is doing with their bonds, it could have market impacts here. But as you said, it's also the data that matters. There's a lot of mixed currents in these markets, and sometimes trying to attribute certain moves simply to one or two things isn't really capturing the whole picture here. Either way, this week we saw a lot of sectors lose some of that momentum, roll over broadly, but it could just be a natural correction and a buy the dip type of move, as that's what we've seen in markets and a lot of other sectors as well. So, Mark, always great chatting with you. Thank you very much for taking time with us on this Friday. I'll post a link to your blog, Mark to Market, and we'll touch base with you next week. Have a great weekend, Mark.
Good luck to everybody.